I see you, Hope.
Yeah, I'm going to not have that.
You guys can't see me.
The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Just give us a couple more minutes here. You should probably be able to hear, but not be able to respond to. So we'll give it a couple more minutes, and at 11 o'clock Eastern Time, we will officially start. All right, welcome everyone. Thank you for joining us today. My name is Tony Bright, and I have with me today Jim Milano. We are going to be talking about appraisal issues and how these issues affect mortgage lenders. Before we get started, I just wanted to let you know that we are using WebEx or GoToMeeting today. Your phone lines are muted. If you wish to ask a question, you can use the chat dialog box on the corner of your screen to submit a question to Jim or Tony. Today's slides will be made available after the session, and if you have any questions, again, please use the chat button. Today's topic is appraisal management issues and the regulations surrounding appraisals and appraisal management. Some lenders take their appraisal management functions in-house, so we thought it would be a good time to go over the regulations that apply to appraisal management, depending upon whether you use an AMC or you undertake the process as a lender for your in-house business. Jim Milano is a partner in the Washington, D.C.-based mortgage banking firm of Weiner Brodsky Kiter. Weiner Brodsky's mortgage banking practice is national in scope. Jim represents lenders and settlement service providers on a nationwide basis, involving issues of both federal and state regulations and compliance with mortgage banking and settlement services. A good part of Jim's practice involves representing appraisal management companies. Again, I am Tony Bright. I am the Chief Compliance Officer for Coaster VMS. Prior to joining Coaster VMS, I was the Executive Director for the Iowa Real Estate Appraiser Examining Board. I was with the board for almost 8 years. And in addition to that time with the Iowa board, I also have over a decade of experience in real estate as a broker and in the industry itself. With that, I'm going to turn it over to Jim to let him start the webinar.
Thank you, Tony, and good morning, everyone. Thanks for joining. As Tony said, my name is Jim Milano, and I'm a partner in the Washington, D.C.-based mortgage banking firm of Weiner Brodsky Kiter. Again, Weiner Brodsky's mortgage banking practice is national in scope, and I work with lenders and settlement service providers on a nationwide basis involving issues of federal and state regulation and compliance with mortgage banking and settlement services laws. And as Tony said, a good part of my practice involves representing appraisal management companies. As you can see here on slide 2, and as Tony said, we're going to address today appraisal issues and how those issues affect mortgage lenders. We're going to spend most of our time today on a CFPB regulation codified in Regulation Z at section 1026.42 on valuation independence. We assume most of you are familiar with this rule, but I think it bears repeating that this is a CFPB rule on appraisal and appraisal management. There's a little bit of history to this regulation that I want to go over quickly. Some of you may recall the Home Valuation Code of Conduct. That was an appraisal protocol put out by Fannie Mae and Freddie Mac in 2008 and 2009. This code arose out of allegations by the New York Attorney General that lenders were improperly influencing appraisers to inflate appraisals on the home loans that they were making. Tony, I think we can stay on slide 2 if you want for a little while. As part of the DoddFrank Act that was passed in 2010, Section 1472 of the DoddFrank Act required the Federal Reserve Board to implement regulations to put into place the appraisal independence requirements that were enacted as part of the DoddFrank Act. Those regulations had to be in place within 90 days of the effective date of the DoddFrank Act. And the DoddFrank Act was effective in July of 2010. And this was the first mortgage regulation issued by federal agencies, and it was issued before the CFPB was even up and running. This appraisal independence regulation was issued by the Federal Reserve Board when and at the time that the board still had authority over Regulation Z, where the regulation is codified. And the authority over Regulation Z, however, including the appraisal independence rules, transferred to the CFPB in July of 2012. One thing that I'll mention is that the DoddFrank Act amended the Federal Truth in Lending Act not only to add the appraisal independence requirements that we'll talk about today, but also added a $10,000 civil money penalty provision for violating these provisions. And that's the reason we wanted to talk about this today, because we've seen a lot of news over the past few years about new regulations and many enforcement actions by the CFPB, but mortgage lenders do not appear to us to be talking a lot about appraisal independence regulatory requirements, although we do hear a lot of mortgage lenders talking about the appraisal management process and some lenders wanting to take that in-house. So still, going back to slide 2, if we could go back to slide 2. The topics we'll cover today include valuation independence, customary and reasonable fee requirements, the current regulatory environment, reports of shortages of appraisers across the country and in particular areas of the country, the value proposition that AMCs bring to mortgage lenders, appraisal management functions, and some new regulations that were put out last year that are going to go into effect over the next couple of years regarding minimum requirements for AMCs. If we could go to slide 3. So as I described earlier, the valuation independence rules are contained in Regulation Z, and they're codified in the Code of Federal Regulations. It's Title 12 of the Code of Federal Regulations. That's the banking code of the federal regulations, and it's within Regulation Z. Regulation Z is part 1026, and I'll just call it Section 42 of Regulation Z. So this is where the appraisal independence requirements are. The Federal Reserve Board put them there in the fall of 2010 as an interim final rule, and in July of 2011 the CFPB inherited Regulation Z from the Federal Reserve Board, and I'm going to repeat that several times throughout my talk. I think it's important for everyone to recognize that there are pervasive appraisal valuation independence rules that apply to all residential mortgage loans. It's a requirement that applies to mortgage lenders. Mortgage lenders can contract out these requirements to vendors such as an appraisal management company, or they can handle it themselves. But the important thing is this is a requirement in a CFPB regulation, Reg Z, and there's basically 3 components to the valuation independence rule, and those are, first, the independence of the appraisal process, which are implemented through requirements on conflicts of interest and establishing firewalls from and around the mortgage loan point of sale or loan production functions. That's one part of the valuation independence rule. The second requirement is that fee appraisers must be paid a customary and reasonable fee for their appraisal work. And finally, appraisers that perform appraisals for home loans must be properly qualified. Slide 4, please. So this is the conflict of interest portion of the valuation independence rule. And it basically says that you cannot have a conflict of interest in a covered transaction. And for purposes of our discussion today, as shorthand, a covered transaction is a typical residential mortgage loan. The definition of valuation management is broadly to define to include functions within a mortgage lender. Valuation functions are defined as recruiting, selecting, or retaining a person to prepare a valuation. Valuation includes appraisal, but can include other things like AVMs. Valuation management includes contracting with or employing a person to prepare a valuation. It includes managing or overseeing the process of preparing a valuation, including providing administrative services such as receiving orders for and receiving a valuation, submitting completed valuations to creditors and underwriters, collecting fees from creditors and underwriters for services provided in connection with a valuation, and compensating the person that prepares valuations, or reviewing or verifying the work of a person that prepares valuations. So again, if you're doing this in-house within your mortgage company, you have valuation services and valuation management functions that are going on. Certainly, you could contract this out to an AMC, or you could do it yourself. As I'll talk about a little later, there's no requirement in the law that you contract out the valuation management functions to an AMC. You certainly can do that yourself as a mortgage lender. Slide 5, please. So one of the things the valuation independence rule did was prohibit coercing an appraiser. And those prohibitions include things like seeking to influence a person that prepares a valuation to report a minimum or maximum value for the home securing the loan, withholding or threatening to withhold timely payment to an appraiser because the appraiser doesn't bring back a value at a certain amount, even implying that an appraiser needs to meet, that an appraiser is going to get current or future work dependent upon how they conduct their appraisals and what values they find, excluding persons from lists for future engagements because that person reports a value on an appraisal that does not meet some predetermined threshold, conditioning compensation to an appraiser on the loan closing, or trying to induce an appraiser to mischaracterize, falsify, or alter a valuation report. Also in this rule, a covered person, which would include a creditor or mortgage lender, cannot induce a person, an appraiser, to materially misrepresent the value of the home securing the loan or to falsify or alter the valuation. So, for example, a loan originator may not coerce a loan underwriter to alter an appraisal report to increase the value assigned to a consumer's home that's going to secure a residential mortgage loan. Slide 6, please. Now, there are things that are permitted under the rules. So you can ask an appraiser to consider additional appropriate property information, including information about comparable properties, to make or support an appraisal that a fee appraiser has come up with. You can request that the appraiser provide further detail, substantiation, or explanation for their conclusion about the value reached in an appraisal. You can ask them to correct errors. You can order more than one appraisal, at least under the Appraisal Independence rule. That has other consequences under other regulations, but you're not limited there under this rule. If they breach a contract or if there's substandard performance, you can withhold compensation. I will tell you many states have laws on this for AMCs that don't directly apply to lenders, that if you're going to withhold payment, you've got to notify the fee appraiser of that within certain time periods, and some states specify the manner of communication. Some states require, for instance, certified return receipt requested. I'm not sure that those state laws would stand up in light of federal, e-sign, electronic contracting. It seems to me, certainly email is efficient and people can agree to that, but these state laws, some of them do require, written notification if an AMC is going to withhold payment for breach of contract by a fee appraiser or substandard work. So there are some permitted communications, but you have to be careful there. And as we'll talk about in a second, you have to be careful if you're a mortgage lender who within your shop you are allowing to talk to the fee appraiser. So next slide, let's talk about that. So turning to the conflict of interest provisions, the rule provides that a person preparing a valuation or performing valuation management functions has a prohibited interest in the transaction if that person or an affiliate of that person also serves as a loan officer of the creditor, mortgage broker, a real estate broker, or other settlement services provider for the particular transaction. So a person has a prohibited interest in the transaction if the person is compensated or otherwise receives financial or other benefits based on whether the transaction is closed, is consummated. So under these circumstances, this person is not permitted to prepare the valuation or perform valuation management functions for that transaction. What does this mean? It means that loan officers or mortgage brokers certainly cannot pick the appraiser, but it means more than that. The valuation function includes valuation management functions, and part of the valuation management function is the appraisal management function. So the point of sale also should not be involved in choosing the AMC, because an AMC is part of the valuation management function. And I think in our practice, we see that sometimes. We'll talk a little bit more about, what lenders are doing in this area. And again, there needs to be an awareness of this rule, that it's the CFPB regulation, that it applies to lenders, and it has requirements. Next slide, please. This slide is a chart just to show the rule has allowances for smaller size creditors, and this chart shows the difference between larger creditors and those creditors with less than $250 million in assets. And these tests are determined, you look at asset size for the prior 2 calendar years for any particular institution. Now, in our practice, most independent mortgage bankers who are not banks, their asset size is well below $250 million. But for our bank clients, even quote-unquote small community banks, that are local, many of them have assets well in excess of $250 million. And again, just as an aside, the CFPB has direct supervisory and enforcement authority over larger banks, which have $10 billion in assets, more than $10 billion in assets. But certainly the CFPB has authority over all non-bank mortgage lenders. Those are defined, those types of companies are defined as covered persons under the DoddFrank Act. But as you can see from this chart, there's basically 3 tests or firewalls to establish a safe harbor to not run afoul of the conflicts of interest test under the CFPB's Valuation Independence rule. And again, what is that rule? If I had to sum it up, it's basically you cannot have the loan production function involved with and touching the valuation management function. And there's basically 3 criteria, as you can see on this slide. There's compensation, there's separation of the loan production function from the valuation function, and there's the function of retaining the valuation function processes. So as you can see from this slide, for a larger creditor or a smaller creditor, the compensation of the person either preparing the valuation or performing valuation functions cannot be based on any value arrived at in the appraisal. That applies to any size creditor. The rules on what the loan production function can do is a little bit different depending on the size of the creditor. For smaller creditors, the creditor must require any employee, officer, or director of the creditor who orders, performs, or reviews a valuation for a mortgage loan to abstain from participating in any decision to approve or not approve or set the terms of the transaction. So these are certainly things that, you know, lenders need to have in their policies and procedures. Let's move to the next slide, slide 9. So the other requirement, again, remember I'm basically breaking it down into 3 categories under valuation independence. You need independence of appraisers, which means, you know, you cannot try to coerce them. There cannot be a conflict of interest, and you need to have a separation of the loan production from the valuation management function. Those are all, I'm just putting those generally under you know, valuation independence. The other one is the fee appraisers must be compensated in a manner that's customary and reasonable. Now, if you look at the regulation, the lender's responsible for assuring that this occurs. And there's a lot of rules under the valuation independence rule, the CFPB's appraisal independence rule, on how you arrive at what is a customary and reasonable fee for a fee appraiser on each appraisal. And there's sort of a general facts and circumstances test, as you'll see here in the slide, that can be based on 6 factors, or there's an alternative test where you can base your payments on studies and surveys provided by independent third parties. Again, that's independent third parties. That's not something that the lender comes up with. I think the point here, again, that I want to repeat is it's the lender's responsibility to assure that the fee appraiser is being paid a customary and reasonable fee. And if you look at the general test and the 6 factors, if you're managing your own appraisal function in-house, you need to have a policy and procedure that outlines these factors for every geographic region that you do business in. And, you know, that may sound easy, but it takes a lot of work. It takes a lot of work. Again, this lender can rely upon its agent to establish, you know, customary and reasonable fees for fee appraisers. And obviously, what we're talking about here today, an agent of the lender could include an appraisal management company that surveys what are customary and reasonable appraiser fees in the different markets based on these factors and the overall facts and circumstances. So we'll get to that in a second, the value that AMCs can bring to the lender's process. Next slide, please. Slide 10. So I included this slide in here. I don't want to spend a lot of time on it. We get this question a lot, particularly for you know, AMCs, but certainly lenders could do this also. Volume-based discounts with fee appraisers is allowed. There's a comment in the commentary to the rule. It's the CFPB official staff commentary, which makes it part of the rule, that says volume-based discounts, if a fee appraiser agrees to, you know, accept less money per appraisal pursuant to an understanding that a lender or an AMC is going to send them so much business, that does not violate the coercion provisions of the general rule that says you can't condition, you know, fees on sending work. This is a very important exception to that, and it's in the commentary to the rule. Next slide, please. So I'm going to talk a little bit about what the rule says about a fee appraiser, and then just, reiterate that the appraisers you're using for your transaction approved. And I'm going to let Tony talk a little bit about the state approval process, how onerous that is, and what goes on. But the CFPB, in its Appraisal Independence rule, defines a fee appraiser, and certainly appraisals must be performed by a qualified appraiser. Part of what an AMC can do is put together panels of fee appraisers that are qualified and competent for the geographic region where the appraisal is to be performed. Again, there's nothing in the appraisal rule that requires mortgage lenders to use AMCs. But if a mortgage lender is not using an AMC, this is something that the mortgage lender is going to have to do for itself. It's going to have to go out and identify appraisers in each market, make sure that they're qualified, not only registered or licensed where they need to be licensed, but also that they're qualified to do the appraisal, geographically for that region. And the federal requirements are a floor. States approve appraisers individually, state regulators, that's what Tony used to do. States approve appraisers on a state basis. So the federal requirements are just a floor, but some states can have higher thresholds and more onerous requirements for fee appraisers to become approved. And it's not easy to become approved as a fee appraiser. There's experience requirements, education requirements, testing, there's time periods. Tony, I thought I might turn it over to you to talk a little bit about the state level fee appraiser approval process and what all that entails.
Sure, Jim. Thank you. So as Jim has already referenced, the federal government mandates in certain situations the use of these state licensed or certified appraisers. And then the states are charged with regulating these programs, and the federal government calls it a voluntary program, but you cannot have certified appraisers unless you have this program in place, so it's really mandatory. And as a result, these state programs can place more requirements on appraisers. However, the federal requirements set by the Appraiser Qualifications Board, which is a board under the Appraisal Foundation, has requirements to be a certified residential appraiser. You have to have, in 2008, the Appraiser Qualifications Board took efforts to strengthen the credibility of an appraiser, and in doing so they tightened the requirements. Prior to that, the requirements were pretty loose, and in 2008 they put a little bit of either a degree requirement, you had to have a minimum of an associate's degree or so many college courses, and then so many qualifying hours, etc. In 2015, they further tightened those requirements. And now to become a certified residential appraiser, you have to have at least a bachelor's degree. It doesn't matter in what, but you have to have the degree. You have to have, on top of that, an additional 200 hours of specific education, which they call qualifying education. And that is in specific topics. Each one of them is tested. They're each at least a 15-hour course. They're expensive. I think they start at around $400 or $500 per course, and again, 15 hours each minimum. And then you have to have at least 2,500 experience hours in the field. And you can do that in no less than 24 months. So it's at least 24 months with that 2,500 hours under a certified appraiser. You're going out, and that's the trainee that we've talked about or that you've heard about in the past. You also have to pass a comprehensive exam, and then you also have to pass a review process that's been put in place by the appraiser board of that state. Now, in addition to that, that's the minimum requirements that have been set. In addition to that, some states have also said you can have no more than maybe 4 hours for every residential report that you write. You can only claim, it might take you 15 hours because you're just learning, but you can claim no more than 4 hours for that report. They might also say qualifying education hours are available online. However, in our state, you're required to take them all in the classroom. even though in some states those classes may only be offered once a year. So again, an additional burden. Other states have, there's a course that a trainee and the person's supervisor have to take before they can actually become a trainee under that supervisor. Some states require that course to be taken in person, and it's only offered by their board, and their board only offers it once a quarter, and it's only offered in one location. So those are some of the restraints that some states have to put on additionally to the already very heavy qualifications for an appraiser. Jim, I'll kind of turn it back over to you, because that's in a nutshell what an appraiser has to do. And of course, I will just throw in too that just because an appraiser has 2,500 hours of experience doesn't mean that they're good. Practice makes permanent, but if you're permanently flawed, it doesn't make you good. So that's another area of concern for these appraisers who are trying to get into this industry.
Well, that's a lot, Tony. And you know, we can move to the next slide. I guess I would just say, you know, there's a lot of work to be done there, certainly by fee appraisers. If lenders are managing their own appraisal process, obviously, you know, they need to know what those requirements are when they're reviewing their fee appraisers and the panels they're putting together. And, you know, I think it will also segue into a topic we'll discuss in a little bit here, which is, you know, the reported shortage of appraisers in some areas of the country. But just segueing or pivoting a little bit, so what should lenders do to ensure compliance with all these valuation independence requirements? I would say one of the things, and I would commend you all for dialing in today, is make sure you have a full and complete understanding of all the rules and regulations that are required. Not only that, but the CFPB is very much into, you know, something we call CMS, or Compliance Management Systems, and they want to see, when they come in to audit you or look at you, they want to see, you know, written policies in place. They want to see that lenders have an awareness and an understanding of the regulatory compliance requirements, that there's a written statement of policy on that policy has been internalized into the lender's operations in terms of procedures, and that the lender has the ability to monitor compliance with those policies and procedures, and that the policies meet the regulatory requirements. And the lender also has an ability to monitor where they're not complying with the law and review their own policies, and to correct areas where they see non-compliance. So that takes a lot of resources to ensure compliance with all the rules and regulations. And again, I can't overemphasize it. This is another rule, a CFPB regulation in Reg Z, that you need to be aware of. If you're going to, as a lender, internalize and insource the appraisal management function, you need to make sure you have the appropriate firewalls in place in order to comply with these valuation independent rules. And if you determine it's not cost effective for you to have your own policies and procedures in place to comply with all of these rules and regulations, then, you know, you certainly can outsource all of this to an AMC. Again, I'm repeating myself here, but part of the reason we wanted to discuss this topic today of appraisal independence is because the regulation is codified in Regulation Z, and that is a CFPB regulation, and the CFPB has authority over this regulation. So just as an aside, since 2012, the CFPB has entered into over 120 enforcement actions with financial services companies, including mortgage lenders. Of these settlements, by my count, about 40 of them have been related to mortgage issues. Now, some of those are related to mortgage servicing, but many of them do relate to mortgage origination. But if you do the math, overall, that's about 2 CFPB settlements per month, every month since they've been in business. And as I said before, the DoddFrank Act amended the Truth in Lending civil liability provisions not only to add the appraisal independence requirements to TILA and now Regulation Z, those appraisal independence requirements that we're talking about today, but the DoddFrank Act also revised the Truth in Lending Act to add a $10,000 per day civil money penalty for violating these appraisal independence provisions. That's now codified and has been since the Dodd-Frank Act was enacted into the civil liability provisions of the Federal Truth in Lending Act. And as we've discussed today in our practice at our firm, we've seen a lot of news over the past couple of years about new regulations and the many, many enforcement actions brought by the CFPB. But in our practice, in our experience, mortgage lenders do not appear to us, at least, to be talking about a lot of the appraisal independence requirements that we're talking about today that apply to lenders. However, we have seen in our practice some lenders wanting to bring the appraisal management function in-house. Again, there's nothing in this law that prohibits a mortgage lender from managing its own appraisal management functions, but there are risks, and as we've discussed here today, and there's many requirements. So you have to make sure that if you're going to internalize your appraisal management function, that is independent of your loan production function, that you are assuring that the appraisers are qualified, and that you're assuring that you're paying the appraiser a customary reasonable fee for the geographic market in which the fee appraiser operates. There's also a provision under the CFPB appraisal management regulation that states, in connection with a covered transaction, which for purpose of our discussion today would be most residential mortgage loans, in connection with such a transaction, if a creditor knows at or before the closing of the loan there's been a violation in the appraisal management process regarding either a mischaracterization of value of the appraisal, or if there was a conflict of interest, then the creditor is not supposed to close that loan unless the creditor can document that it's acted with reasonable diligence to determine that the valuation does not materially misstate or misrepresent the value of the home securing the loan. So that's another requirement under the appraisal independence rule that you as a lender have to monitor to make sure no value has been mischaracterized, no conflicts of interest. These firewalls I've been talking about have been breached. Next slide, please. So we talk about aggressive regulators, and that, dominates the news every day, almost every day, every week. We see a new enforcement action, a new settlement. The most recent one was all the news, about the Wells Fargo matter. I will mention, there was, everyone's seen in the news, one recent victory by industry last week in the PHH case, and maybe that can be a subject of a future webinar that Coaster VMS hosts. I will tell you our firm was involved in that case from the beginning, and I think that's going to change the tenor and the tone of some of the CFPB's enforcement stances going forward. It certainly gives mortgage lenders better defenses in areas of statute of limitations and in the RESPA arena, but that's not part of our talk today. But I did want to talk about one case out of a mortgage company, a couple of matters. One was a settlement reported by the CFPB of a mortgage company based out of Atlanta, and another one was an affiliated AMC affiliated with a lender also based out of Atlanta. But in this one case, there's a couple of things going on. The CFPB alleged that there was bait and switch mortgage advertising, but the lender also had an affiliated AMC. Now, this is a little bit different than having your appraisal desk in-house. This was actually a separate company, an AMC affiliated with the lender, which again, there's nothing wrong with that. There are rules under the appraisal independence rule that says if you're an affiliated AMC, the firewalls and the safeguards that we've talked about still apply. But in this case, the lender allegedly required consumers to order and pay for the appraisal with the orders going through its affiliated AMC. They were allegedly, the lender was allegedly requiring that before they provided GFEs. This is before TRID went into effect. And the lender allegedly did not tell the consumers until later that the appraisal orders were being funneled through its affiliated company. There were other allegations in this matter that the lender also charged consumers for quote-unquote appraisal validation reports without disclosing that this service was being provided by the lender's affiliated AMC, and there were also allegations that the AMC had marked up the price of these reports by as much as 900%, and that consumers were led to believe that the lender had gone out and bargained for this third-party service, and the lender was apparently marketing or describing this particular settlement service, the appraisal function, as a special deal to its lender customers. This is the only mortgage origination settlement that I found with the CFPB where AMC issues were involved. But as you can see from the slide here, the penalties were huge. I mean, this is a non-bank mortgage company, almost $20 million, almost $15 million in restitution to consumers and a $4.5 million civil money penalty paid to the CFPB. So again, this just drives home the point of what the rule requires: independence. You need to have independence from your loan production function. The valuation management function needs to be independent, regardless of whether you, as a lender, or performing your appraisal management function in-house, or even the selection of fee appraisers or AMCs. So what we're seeing and hearing in our practice is some lenders are telling, potential salespeople, branch managers or loan officers, saying things like, come to work for us. We have our own appraisal desk. We give you control over the appraisal, so you have input and you have influence over, whether your deals close or not. I mean, they actually put that in marketing pieces in an email. That's a huge mistake. That's a red flag. I mentioned the other case out of Georgia. There was also recent press within the past 6 months out of Georgia. There was an AMC that was affiliated with a lender where the lender was telling people, you need to send your loans to us. We'll get you the value you need because we have our own AMC. And they pick the appraisers, and we can get you the value that you need. I mean, this was very embarrassing both for the lender and this AMC when it hit the press. Now, I don't know that any administrative enforcement action has been taken on that one yet, but we continue to watch it, and I would not be surprised if the Georgia mortgage regulator got involved in this one. We continue to watch this case. Tony, I'm going to take a breather there and turn it over to you to let you go over some additional information.
Sure, Jim. So we're going to kind of go back to talking about a shortage of appraisers and whether it's real or not. According to the Appraisal Institute, the number of appraisers will shrink in the next 5 years because of an older workforce. Now, I can tell you that this discussion is an arguable one amongst appraisers and amongst others within the industry. Some argue that the market has actually balanced itself out and that there is no such a shortage. Others say it's supply and demand. Those areas that are getting hit really heavy with a lot of refinances or a lot of new home purchases are just feeling the effects of having the right amount of appraisers, but it's just a very busy time period. What I can say is that this conversation of a shortage of appraisers I have heard this in the regulatory world for at least the 8 years that I've been going to conferences that have to do with specifically with appraisers. So this isn't something that's new as far as the discussion, but I think that it is becoming more pertinent because it is impacting people in a greater scale in more areas of the country. And again, the appraisers, what we talked about a little while ago, appraisers have found themselves constrained with all kinds of extra regulations since '08 when trying to make it more into a career rather than just what some had perceived as a trade before. So trying to make it a more professional field of occupation, and as a result, all of these additional regulations have kept some people from wanting to get into the industry. I will also warn, though, that in that time period, there's some statistics out there where they say that, you know, in 2014 there were X number of trainees, and in 2015 the number dropped drastically. And yes, that is true, but keeping in mind too that those statistics are slightly skewed in the fact that 2014, a lot of those trainees were hurrying to get their certified credential before the 2015 criteria hit, and there were changes to it. So while there was a larger number of trainees in 2014, 2015 lower numbers are not necessarily a true reflection, because a lot of those 2014 people are now certified appraisers in the 2015 category. Just something to keep in mind when people are throwing out those statistics to you. Sometimes they are slightly skewed because of the regulation changes that have taken place. However, rural areas, according to the Institute, it's worse in certain areas of the United States that are rural, and I would completely agree with that. We're seeing across the country the rural areas, and when we say rural, we're not just referring to the rural areas that are residential, small towns, and the houses that are inside of them that are the residential properties. This also impacts the agriculture or the small farms that are out there that would probably be considered having to be have a certified general appraiser do the work because of the requirements involved. But those areas certainly are more heavily hit. And it's serious enough now that the Bankers Association has stepped forward and urged the FFIEC to look into the shortage of the qualified appraisers in those areas. Shortly before I left my former job, our bank superintendent was hearing a lot of this from the small banks in the state of Iowa. And again, it's the specialty assignments oftentimes that is where the appraisers are lacking because of the either the appraiser. There was one situation I can think of. There was an appraiser who worked in one specific market, excellent in an agricultural capacity, and when he passed away, there was literally no one within an area that was considered to be geographically competent to be able to perform those appraisals. So as a result, it left a huge those areas. So we've talked about the requirements for a lender. We've talked a little bit about the appraiser shortage and the regulations for appraisers. So what is the value of an AMC? What do AMCs do? Some people have a false idea of what really happens at an AMC. So I just kind of want to go over that briefly with you. When a lender hires an AMC, they are essentially outsourcing all of their appraisal responsibilities that they as a lending institution have. Now notice that it doesn't mean that their regulatory responsibilities are gone. It just means that they have are using an AMC to help with those responsibilities. And as a result, that includes selecting a qualified state appraiser, which as an AMC, it becomes that AMC's responsibility to make sure that they have a good pool of qualified appraisers that they can use that are competent geographically and are experts in the fields that they are being hired to perform that appraisal. They also need to make sure that those appraisers are performing their reports, that they're doing their reports in compliance with the Uniform Standards of Professional Appraisal Practice, known as USPAP. And that is thrown around a lot in the appraiser world. But those are federal guidelines that an appraiser must comply with when they are writing any report and they are signing it as a certified appraiser. That means it has to comply with USPAP. And as a result of that, there are certain review requirements that must be done, and an AMC takes on that responsibility and does that as well. They also make sure that the appraiser is completely independent, and as a result that there is none of the appraiser independence questions brought into play. The AMC also vets the appraisal fully and does everything they can to attempt to make sure that it complies with USPAP. Our technology at our company at Coaster VMS, we allow the appraiser to perform his duties while maintaining independence in the process, which helps keep the appraiser and the lender independent of one another so that they are not communicating directly, but through us instead. And we also manage the expectations within the process, as well as the timeline for ordering of the appraisal report all the way to the delivery. And I can tell you that those services that we provide and the compliance that goes into that are taken very seriously, and the compliance is not something that we take lightly. Appraisal independence is something that, along with the other regulations, we do truly monitor. We want to make sure that there is no reason to question the appraiser's report and that they have been able to reach an independent conclusion of value. How else do we bring value? Again, we implement the firewall between the appraiser and the lender, as we've talked about previously, and that is truly important. It helps keep the lender, give them peace of mind that they don't have to worry about being accused of any kind of independence violation on that. And then we also have the quality control, which was previously mentioned. As an AMC, we are monitored very closely by states. We have, there are currently 37 states with AMC legislation. And so we are monitored by states. Right now, not as much in all states because we haven't got quite to that point, and we'll discuss that in an upcoming slide. But we also have screening and ongoing assessment processes, and we just make sure that everything within it meets the standards that are required within the industry and required under USPAP in addition to the federal guidelines. We also help the lender manage the appraisal process, just again making sure that the timelines are met, that the expectations are met within the entire process. We make sure that the relationship is running smoothly with the appraiser, the turn time of the report, the inspection is getting done, and again, we make sure that we provide compliance within the process. And of course, as a national AMC, we have a better chance to find an appraiser in a difficult market area that maybe you do not tend to lend in very frequently or have know of appraisers. We specifically have a department that actually spends their day finding qualified appraisers to complete reports in difficult locations or for unique properties that are not easily to have a report done in. So we're working very carefully to make sure that those reports are assigned to competent appraisers, and not only in geographic competence but also in the kind of property, to make sure that they have the property competence necessary. And if they don't have it, that they can gain the competency necessary. So those are ways that we as an AMC function. And again, having people that are dedicated to do that full time to make sure that those assignments are aligned with the proper appraiser to keep the process in compliance. There are minimum requirements for AMCs. Jim, I'm going to let you kind of run with a few of these things on here and talk about that.
Okay, certainly, and we have less than 10 minutes left, so I'm going to run through this quickly, but just more regulation for AMCs, just so everyone will have a background on this. In the late spring of 2015, 6 federal agencies, the Office of Comptroller of the Currency, the OCC, the Federal Reserve, the FDIC, the National Credit Union Administration, and the CFPB, and the Federal Housing Finance Agency approved rules creating federal minimum requirements for state registration and supervision of appraisal management companies. Now, this final rule was required and implemented Section 1473 of the DoddFrank Act, which added requirements for appraisal management companies. This law does not require states to establish AMC registration, nor are there any penalties imposed on states that don't establish a regulatory structure for AMCs. However, if a state has not adopted the minimum AMC requirements established by this rule within the time period, which is 36 months from the date that the final rule was published in the Federal Register, which was August 2015. So all states will need to have in place minimum AMC requirements by or before August 2018. If a state does not adopt the AMC minimum requirements by that time, then AMCs will be barred from providing appraisal management services for federally related mortgage transactions unless the AMC is owned and controlled by a federally regulated insured depository institution such as a bank. Now, as I said, the final rule was published in the Federal Register in August of 2015, and the states have 3 years from that date to implement the minimum standards. There is a possibility that a state could request a 1-year extension if they needed it. And the reason for that is some states, for instance, Texas, meets every 2 years. So if they miss this deadline, they might get an extra year. But federally regulated AMCs, those are ones affiliated with banks, are going to have 12 months, and basically that passed a couple of months ago. They had 12 months from the rule second to comply with the requirements. But under the minimum standard, each state that chooses to participate must have an AMC licensing program that meets certain minimum criteria and impose certain minimum requirements on AMC subject to state regulation and state registration. So there's about 7 things that a state's AMC licensing program must have, and those include a mechanism to review and approve or deny AMC's application for initial registration, review and renewal or deny renewals, a process to examine the books and records of AMCs operating in the state, and also to require AMC to submit reports and information, a process to verify that appraisers on the AMC panel hold valid state registrations or licenses, a process to conduct evaluations of AMCs, compliance with laws, a process to discipline AMCs that violate appraisal-related laws and regulations, and a process to report an AMC's violation of applicable appraisal-related laws, regulations, or orders, as well as any disciplinary or enforcement actions or other information relevant about an AMC's operations, and that's all to be reported to the appraisal subcommittee. All of the AMCs subject to state registration are going to have to satisfy certain minimum standards, and there's generally 5 of them. They're going to have to register and be subject to supervision by a state appraiser regulator. They're going to only be able to engage certified or state licensed appraisers for transactions, basically federally related transactions. They're going to have to establish, AMCs will have to establish and comply with processes and controls designed to ensure that the AMC only engages appraisers who have the appropriate education, expertise, and experience necessary to competently complete appraisal assignments. Their AMCs are going to have to oversee and direct appraisers to perform appraisal assignments in accordance with USPAP, and AMCs are going to have to establish and comply with processes and controls that are reasonably designed to ensure that the AMC conducts its appraisal management services in compliance with the Valuation Independence rule under the Truth in Lending Act and regulations that we've been talking about on our call today. Importantly, it's a couple of things. The states are free to impose additional requirements on registered AMCs, and these provisions of the DoddFrank Act, which amend FIREA, are not intended to prevent states from establishing additional requirements in addition to the minimum requirements. So to summarize, from my standpoint, bank-affiliated AMCs, the states have 3 years from August 2015, that's August 2018, to establish AMC registration requirements and meet the minimum standards that we've outlined here. These minimum standards are a floor, not a ceiling. The states can certainly do more. And with that, Tony, we have a few minutes left. I'll turn it back over to you.
Thanks. I think just a couple of other things that I would reiterate. I had mentioned earlier that currently there are 37 states that regulate AMCs. There are 3 others that have legislation that has passed but it has not been implemented, so we have not been required or have not been asked to register in those states yet. With regard to the others, they all, to my knowledge, are planning to regulate AMCs, with the exception of, I have heard that the District of Columbia is considering not registering AMCs, and that there are 2 or 3 states who are currently registering AMCs who are considering opting out of the voluntary program. Once they get their local community banks and their state banks involved, I would be surprised if any of them actually do opt out, but that is yet to be seen. I will also say that effective 2018, one way that the states will be able to financially handle these new programs is not only through the AMC registration fees, but the appraisal subcommittee is required to collect $25 per appraiser that is on an AMC's panel. So obviously any appraiser that we have on our panel, we want to make sure that they are highly qualified, competent, and are good appraisers, because we as an AMC will be paying $25 per appraiser per state that we have them on an appraisal panel. And one other thing is, I think I've only heard of one AMC that is a federally regulated AMC that would be exempt from these AMC requirements on the state level. And that's all I have to add.
Well, I think we're right on time. We're right on the hour. So this is information packed. I hope everyone that dialed in enjoyed it and got a lot of information out of it. I haven't seen many questions come in, and we're out of time, but if anyone has any questions, our contact information are on these slides, and as Tony said, we'll be sending them out. Feel free to reach out. And from my perspective, I would like to thank you, Tony, and Coaster BMS for putting this together. And I would like to thank everyone for dialing in today.
Yes, thank you, Jim. Thank you to your law firm and Wiener Brodsky Kiter, and thank you to everyone that has joined us today. We appreciate you being on the call. We will follow up with the slides in the near future. Thank you and have a great day.